You are standing in the driveway. It is a Tuesday afternoon in early spring, and the light is the kind of pale, flat gray that sits over southern Ontario for weeks at a time before it decides to become anything. You have just come back from picking up groceries. Nothing unusual? You checked the total at the register and it was higher than you expected, the way it always is now, and you made a mental note the way you always do, and you drove home. You carry the bags inside, you drop your keys on the counter, and there is an envelope on the kitchen table that your partner has left out for you, and something about the way it has been placed there, slightly apart from the other mail, face up, tells you before you even pick it up that this is not something that can wait. The return address is your mortgage lender. The envelope is thicker than a statement. You open it, and the number inside, the new monthly payment figure printed in clean institutional typeface in the middle of the page, does not register correctly the first time you read it. So you read it again. And then you sit down because your legs have made that decision before your brain has fully caught up to what your eyes are telling you. Welcome back to Canada Property Watch. In a previous investigation, we exposed how Canadian banks are legally authorized to freeze every account you hold at their institution simultaneously, without a court order and without advance warning, using a right of offset clause buried inside your mortgage agreement that almost no borrower has ever read carefully. We showed you exactly how that administrative kill switch operates and who it is already being used against. Today, we are examining the event that is feeding that pipeline. The event that is pushing tens of thousands of Canadian mortgage holders from manageable stress into the kind of financial crisis that triggers those freezes, those power of sale proceedings, and those deficiency judgments that follow borrowers for a decade. We are examining the mortgage renewal shock of 2025 and 2026, the 40% payment increase that hundreds of thousands of Canadians are either currently living through or are about to encounter. And we are going to walk through with mathematical precision exactly what that number means in a real household budget, exactly who is most exposed, and exactly what the sequence of events looks like when a family that stretched to buy during the peak years of the pandemic boom finally hits the wall that was always waiting for them at the end of their 5-year term. To understand why this is happening with such brutal mathematical force right now, you need to understand the specific temporal trap that was set in 2020 and 2021, even though nobody called it a trap at the time. During those 2 years, the Bank of Canada held its overnight policy rate at the lowest levels in the institution's history. The target rate sat at 25 basis points, effectively zero. In practical terms, this meant that a Canadian borrower in 2020 or 2021 could lock in a 5-year fixed mortgage rate somewhere between 1.6 and 2.4%, depending on the lender, the term structure, and the negotiation. Those rates were not normal. They were emergency rates deployed during an unprecedented economic contraction. They were always intended to be temporary. But when you are a 34-year-old buying your first home in Mississauga or Guelph or Kelowna or Halifax, and every mortgage broker and real estate professional in your life is telling you that this is the moment, that rates will not stay this low forever, and that you should move now, the temporary nature of emergency monetary policy does not feel like a threat. It feels like an opportunity, and hundreds of thousands of Canadians took it. Those 5-year fixed terms are now maturing. The borrowers who signed in 2020 began hitting their renewal dates in 2025. The borrowers who signed in 2021 are hitting theirs now, and through the remainder of 2026. And the rate environment they are renewing into is not 2%. It is not even close to 2%. The posted 5-year fixed rates available to Canadian borrowers at renewal in 2025 and 2026 have been sitting in a range between 4.7 and 5.8%, depending on the lender and the borrower's current credit profile. For a borrower who is renewing cleanly with no missed payments and strong current income documentation, the best available rates are still representing an increase of 2.3 to 3.5 percentage points over what they were paying. And for a borrower whose credit profile has deteriorated, whose income documentation has gaps, or whose property has declined in appraised value relative to the outstanding mortgage balance, The renewal rate being offered is not the best available rate. It is a risk-adjusted rate that can be materially higher, and in some cases the lender is not offering renewal at all, and is instead triggering a full qualification reassessment that the borrower fails. Now let us make this concrete, because abstract percentage point discussions are exactly the kind of thing that allows people to intellectually understand a problem without feeling its actual weight. Let us look at the numbers in a specific, realistic scenario that represents an extremely common profile among Canadian borrowers who are entering renewal right now. Consider a household we will call the Okafor family. They bought a detached home in the Hamilton to Burlington corridor in late 2020 for $820,000. They put down $164,000, which was a 20% down payment that represented essentially their entire liquid savings, plus a gift contribution from parents. Their mortgage at closing was $656,000. They locked into a 5-year fixed rate at 1.89%. Their original monthly payment was approximately $2,740. That payment was tight but manageable. Both adults were working, one in healthcare, one in a mid-level logistics management role. Combined household income at the time of purchase was approximately $142,000. Their gross debt service ratio at origination was well within the guidelines. The file was clean, the approval was straightforward. Fast forward to the renewal date in late 2025. The outstanding balance on the mortgage after 5 years of amortization payments is approximately $591,000. The amortization period remaining is 20 years. The renewal rate being offered by their lender, based on current market conditions and the borrower's current profile, is 5.14%. The new monthly payment at that rate on the remaining balance over the remaining amortization is approximately $3,910. The increase from their original payment is $1,170 per month. That is $14,040 per year in additional mortgage expense being extracted from a household budget that has simultaneously been absorbing 2.5 years of elevated grocery costs, elevated utility costs, elevated insurance costs, and in one case, a period of reduced hours at the logistics employer. Following a restructuring exercise in early 2024, $1,170 per month. That number is not theoretical for the Okafor family. It is the difference between a household that functions and a household that begins making the triage decisions that eventually lead somewhere much worse. It is the difference between contributing to the RRSP and stopping contributions entirely. It is the difference between maintaining the vehicle or deferring the repair. It is the difference between a family that absorbs the shock and a family that begins using the credit card to cover the gap between income and expenses, which is the beginning of a specific and very well documented debt spiral that the bank's own internal risk models are built to detect. And here's the question you need to sit with right now, because this is where the video stops being about someone else and starts being about the mathematics of your own situation. How many Canadian households that signed 5-year fixed mortgages between January 2020 and December 2021 are in a materially similar position to the Okafor family? The answer, based on mortgage origination volume data from that period, is not a small number. The Bank of Canada and OSFY have both publicly acknowledged in their financial system review publications that the cohort of mortgages maturing between 2025 and 2026 represents one of the largest renewal stress events in modern Canadian mortgage history. We are not describing a fringe scenario. We are describing a structural condition affecting a statistically significant portion of the Canadian homeowning population simultaneously. Now, let us go further, because the payment increase itself is only the first layer of this problem. The second layer is what happens when the payment increase intersects with a property that has declined in value relative to the original purchase price. And this is the dimension that is turning a painful but potentially survivable payment shock into an absolute financial execution for a specific subset of Canadian borrowers. During 2022 and into 2023, Canadian real estate markets in many urban and suburban areas experienced significant price corrections following the rate hiking cycle initiated by the Bank of Canada in March of 2022. What markets that had seen the most dramatic appreciation during the 2020 and 2021 frenzy experienced the most significant pullbacks. In some Hamilton neighborhoods, in certain Barrie and Innisfil markets, in parts of the Fraser Valley in British Columbia, and in suburban Edmonton and Calgary corridors that saw speculative buying during the boom. Properties purchased at peak pricing in late 2021 or early 2022 are still worth materially less today than what was paid for them. Not in every case and not everywhere, but in enough specific markets and enough specific property types that the intersection of negative or flat equity with a mandatory payment increase at renewal is now creating a category of borrower that the financial system does not have a good solution for. Because here is what negative or flat equity does to your renewal options, or it eliminates them. If your property is worth less than or equal to what you owe on your mortgage, you cannot switch lenders at renewal. You cannot go shopping for a better rate at a competing institution, because no competing institution will approve a mortgage for more than the appraised value of the property, and your outstanding balance equals or exceeds that value. You are locked in with your current lender, and your current lender knows you are locked in, and the rate they offer you under those conditions reflects that knowledge. You are not a valued client exercising their right to take their business elsewhere. You are a captive borrower with no leverage and no exit, and the renewal rate you receive in that position is not the rate that was advertised on the lender's website. It is the rate that the lender determines is appropriate for the risk profile of a borrower whose collateral has deteriorated and whose payment history may be showing signs of stress. And this is where the mechanics of the situation become genuinely terrifying for the people living inside them. Because the Okafor family, or any family in a materially similar position, is now facing a set of choices that are all variations of bad. They can accept the renewal at the offered rate and absorb the payment increase, which requires either finding new income, cutting expenses that may already be at the bone, or beginning to use revolving credit to bridge the gap, which is a temporary solution with a catastrophic long-term trajectory. They can attempt to sell the property, but if they are in a market where values have deteriorated, the sale proceeds may not cover the outstanding mortgage balance, plus the transaction costs, plus the penalty for breaking the term early, which means they cannot sell their way out of the problem without writing a check at closing, or they can do nothing. Miss a payment, enter the lender's internal hardship process, and begin the sequence of events that we documented in detail in our previous investigation. The freeze, the audit, the power of sale, the deficiency judgment. There is no fourth option that is clean and painless and free. The trap closed when the rate environment changed, and the only question now is which of the available exits causes the least permanent damage. Let us also examine something that most financial commentary on this subject completely ignores, which is the psychological and behavioral dimension of how families actually respond to payment shock. Because the way people respond to this specific financial stress is not always rational and not always optimal, and the gap between the rational response and the actual response is where a lot of the most serious damage happens. When a household receives a renewal offer with a payment increase of $1,000 or more per month, the statistically most common initial response is not to immediately seek legal or financial counsel, refinance strategically, or begin a structured review of household expenses. The most common initial response is a combination of denial and improvisation. Families draw down their HELOC to cover the gap. They increase their credit card utilization. Also, they defer RRSP contributions and treat the freed up cash as income. They reduce but do not eliminate the discretionary spending, which means they are spending less than before, but still more than they can afford. And they tell themselves, and each other, that this is temporary, that rates will come down, that the situation will resolve itself. And some of those families are right. Rates have moved, and for borrowers who can survive the next 12 to 18 months, there is a plausible path through. But for families who began the improvisation phase with thin cash reserves, high existing consumer debt, or income that has not kept pace with inflation, the improvisation phase does not buy time. It buys a few months of surface stability at the cost of making the eventual reckoning substantially worse. The HELOC drawdown is a particularly devastating version of this pattern because it converts a flexible credit facility into a rigid obligation at precisely the moment when the household's cash flow is already under maximum stress. When you draw down your HELOC to cover monthly mortgage payment increases, you are increasing your total debt load, increasing your total monthly payment obligations, including the HELOC minimum payment, and reducing the credit cushion that would otherwise be available as a genuine emergency buffer. You are not solving the payment shock problem. You are deferring it by 30 days and making it 20% larger in the process. The families who are doing this right now, across thousands of Canadian households simultaneously, are not making irrational decisions from their own perspective in the moment. They are making the human decision to preserve the appearance of normalcy for as long as possible, to keep the kids in the same school, to keep making the payment on the vehicle, to avoid the conversation with the bank that feels like an admission of failure. That impulse is completely understandable, and it is the exact mechanism that transforms a painful but survivable payment shock into a systemic financial crisis that damages not just individual households, but the communities and local markets they are embedded in. Because when enough households in the same neighborhood or the same suburban corridor hit the reckoning simultaneously, the downstream effects reach every property on those streets, regardless of whether the individual homeowner is in distress or not. The forced sales push comparable values down. The reduction in discretionary spending hollows out the local retail and service economy. The construction pipeline that was counting on equity-rich homeowners doing renovations and additions contracts. The property tax base that municipalities depend on begins to look less stable than it did in the 5-year forecast. It is a collateral damage event that operates at the community level, and it is already beginning to manifest in specific markets across this country. What can you actually do if you are inside this scenario or approaching it? First, and this is not a comfortable answer, the time to act is before the renewal notice arrives, not after. If your term is maturing in the next 6 to 12 months, you need a current appraisal of your property's value. A realistic accounting of what renewal rates you will qualify for given your current income and credit profile, and a clear-eyed conversation with a licensed mortgage professional about whether your current lender is your only option or whether there are alternatives. If your equity position is strong, you may have more options than you think. If your equity position has eroded, you need to know that now, not on the day the renewal letter arrives, because the options available to you decrease with every week you wait. Second, the HELOC is not a solution. If you are currently using revolving credit to bridge a cash flow gap created by payment increases, you are not managing a problem. You are inflating it. The interest accumulating on that drawdown is compounding against you, and the minimum payment obligations created by the drawdown are reducing your future financial flexibility at exactly the moment when you will need it most. Third, if you have already missed a payment or are about to miss one, the worst thing you can do is avoid contact with your lender. Lenders have formal hardship programs, and those programs, while not pain-free, are substantially less destructive than the administrative enforcement pathway that is triggered when a borrower goes silent and delinquent. A borrower who calls their lender, explains their situation, and requests a formal review is being processed through a different internal workflow than a borrower who stops responding to correspondence. The outcomes are different. The timelines are different. The permanence of the damage is different. And if you are watching this as someone who is not currently in mortgage stress, who locked in at a rate that does not mature for another 2 or 3 years, do not make the mistake of treating this as someone else's problem that exists at a comfortable distance from your own financial reality. The wave of renewal stress that is currently moving through the 2020 and 2021 cohort will reach the 2022 and 2023 cohort. It will reach property values in your neighborhood through the comparable sales mechanism. It will reach your employer through the reduction in consumer spending that is the mathematically inevitable consequence of extracting $14,000 per year from hundreds of thousands of Canadian household budgets simultaneously. This is not a contained event. It is a systemic pressure that is distributing its damage across the entire economy in ways that are diffuse enough to be invisible until they are suddenly and unmistakably not. Subscribe to Canada Property Watch right now and make sure the notification bell is activated. because in our next investigation, we are going inside the CMHC data, postal code by postal code, and identifying the specific neighborhoods where the combination of peak era purchase prices, current appraised values, and renewal stress overlap in a pattern that historically precedes a localized price collapse. We are going to name the corridors. We are going to show you the numbers, and we are going to explain exactly how the families 3 doors down from you, in a house that looks exactly like yours, are sitting inside a financial structure that is mathematically unsustainable and that will resolve itself one way or another before the end of 2026. That investigation is coming. You need to be here for it.